Have you ever driven away from a car dealership, with that amazing new car smell?
Mm-hmm.
Feeling great, but maybe, just maybe, a bit hazy on all the finance details.
Happens all the time.
Or maybe you wrestled with loan terms later, wondering, did I actually get a fair shake?
Mm-hmm.
Well, you're definitely not alone there. Many of us sign on the dotted line without really getting into the weeds of the fine print. And sometimes, well, that can cause issues down the road.
It certainly can.
So today, we're diving deep into something that could really shake up a lot of those past car finance deals. The Financial Conduct Authority, the FCA, they're getting ready to consult on a massive, industry-wide compensation scheme for motor finance customers.
It's a big one, not just tinkering around the edges.
Exactly. This is about sorting things out, making sure there's real fairness for potentially millions of people who might have been treated unfairly. We're talking hidden commissions, that sort of thing.
Right. Undisclosed commissions are at the heart of it.
So our mission here today is to unpack all of this. Why is this scheme needed now? What actually led up to this point? What does it mean for you if you think you might be affected?
And also what firms need to be thinking about urgently.
Absolutely. We'll look at a crucial Supreme Court ruling that was a real turning point. We'll explore the principles behind this whole thing and, get into the nitty-gritty of what compensation could look like.
It's a lot to cover, but really important.
Now, just so everyone knows, the factual basis for our deep dives today, all this detailed information, it was supplied to us by Compliance Consultant. They're known as the home of the compliance doctor.
Real experts in this field. Financial compliance is their bread and butter.
Definitely. You can find out much more about them, maybe even schedule a no-obligation discovery call. Just head to their website. It's complianceconsultant.org.
Or email info@complianceconsultant.org.
Or if you're in the UK, you can phone them, 0800-689-0190. And there's the direct link, too, for scheduling that call. bit.ly/ccdiscover. That's bit.ly/ccdiscvr.
And they've got something pretty special going on right now, don't they?
They really do. It's right here in the source info. Compliance Consultant is celebrating their 25th anniversary.
Wow, 25 years.
With a 25% discount for the whole of 2025. Plus, over $9,999 in bonuses on top. It's a fantastic offer, especially if you're a firm navigating these complex rules.
Definitely worth checking out.
Okay, so let's dig in. This proposed compensation scheme. But it's a huge step. What was the real catalyst? What pushed the FCA to act now and on this scale?
Well, it's interesting because it's been brewing for a while. The FCA did this really comprehensive review looking back at how motor finance deals were done.
Okay.
And what they found was, well, frankly, a lot of firms just weren't following the existing laws or their own rules about disclosure, especially around commissions.
The non-compliance was pretty widespread.
It seems that way, yes. And the FCA's view is clear. If consumers lost out because of that, they need to be put right, but in a structured way.
Right.
Orderly, consistent, efficient, not just a free-for-all.
Right, makes sense.
But the real trigger, the thing that really shifted the ground, was a Supreme Court ruling. It came down on Friday, August 1st, 2025, the Johnson case.
Ah, yes, the Johnson case. I've seen that mentioned.
It was pivotal. It clarified what counts as an unfair relationship under the Consumer Credit Act, particularly regarding commissions paid to dealers. And crucially, whether those commissions were properly explained to the customer.
So the disclosure part was key.
Absolutely. The court basically agreed with a lot of the factors the FCA had already flagged as potentially creating that unfairness. It really cemented the legal foundation for what the FCA is proposing now.
Okay, so that's where it gets really interesting for people listening. This Johnson case set a precedent. What were those specific factors? The things the Supreme Court pointed to that could signal an unfair relationship? Because that seems central to understanding if you might be affected.
Exactly. The judgment laid out several key things to look for. First, the sheer size of the commission. How big was it compared to the actual cost of the loan?
Okay, like a percentage.
Yeah. Or just disproportionately large. Second, the nature of the commission. Was it, for example, discretionary? That's a big one.
Discretionary meaning?
Meaning the broker, often the car dealer, could actually adjust the interest rate you paid. And by pushing it higher, they could earn a bigger commission for themselves without you necessarily knowing.
Okay.
Yeah.
That sounds problematic.
It certainly can be if not disclosed. Third, the consumer's characteristics. Were they potentially vulnerable? Maybe less experience with finance. That can be a factor.
Right.
Fourth, did the firm actually comply with the rules that were in place at the time, or did they ignore them?
Compliance history matter.
Definitely. And finally, perhaps most importantly, the extent and manner of disclosure. What were you told about the commission and how clearly? The court did stress, though, it always depends on the specific facts of each case. But these are strong indicators.
So it's not just that commission was paid.
Exactly. Commission itself isn't the issue. It's standard practice in many sales roles. The problem the Supreme Court focused on was the lack of transparency, hiding how it worked, especially if the structure gave the dealer that incentive to charge you more, or if the commission was just so large that not telling you about it fundamentally skewed the deal.
So it undermined the fairness.
Precisely. But the court also said, look, just because something wasn't disclosed doesn't automatically make the whole relationship unfair. It's about the mix of factors and whether it materially affected your decision as a customer. It's a move away from buyer beware towards seller be clear.
Got it. So we understand the trigger, the why.
Yeah.
How is the FCA planning to actually structure this redress? What principles are guiding them, given how complex this all sounds?
Yeah, it's definitely complex, but they're not approaching it randomly. Back in June, the FCA outlined 7 core principles for the scheme.
7. Okay, what are they?
They want it to be comprehensive, cover everyone affected, fair balancing consumer needs with market stability, certain clear rules, predictable outcomes. Then, simple and cost-effective, easy to use, not bogged down in admin, timely, get compensation out efficiently, transparent, how decisions are made. And finally, market integrity, keep the motor finance market healthy long-term.
That sounds like a tough balancing act.
Oh, absolutely. There will be tensions, like making it super comprehensive could clash with making it simple and cost-effective. How do you catch every single nuanced case without creating a bureaucratic monster?
Right.
That's exactly the kind of thing they'll be exploring in the consultation, finding that sweet spot.
Okay, so focusing on the scope then. What specific types of finance agreements are likely to be covered? Is it every single car loan from the past decade or so?
Good question. The main focus, the primary proposal, will be on discretionary commission arrangements, those DCAs we mentioned.
Where the dealer could adjust the interest rate.
Exactly. If those arrangements weren't properly disclosed, that's the key condition, because that structure created a clear potential conflict of interest that wasn't always transparent to the buyer.
Okay, so DCAs are definitely in the frame. What else?
Well, they're also going to consult on including non-discretionary commission arrangements, too.
Even if the rate wasn't adjustable.
Yes, because the Johnson case showed that unfairness could arise even then. If other key facts about the commission, maybe its sheer size or some other unusual feature weren't disclosed, that could still make the relationship unfair under the law.
So the non-disclosure is the consistent theme here.
That's the core issue the FCA and the courts are targeting. It's about the lack of transparency leading to potential harm, not necessarily the commission itself.
Okay, so let's say someone is eligible. The scheme gets set up, they qualify. How will the compensation actually be calculated? That's the million-dollar question.
Yeah.
Or maybe the 950-pound question, based on what you said earlier.
Well, maybe not millions for individuals, no. The calculation methodology is still being worked out, but it'll be guided by a couple of things. 1, the actual level of harm the consumer suffered, and 2, the need to make sure people can still get affordable car loans in the future. They don't want the fix to break the market. Now, remember the Johnson case. The remedy the Supreme Court ordered there was basically the repayment of the commission itself.
Okay.
The FCA is looking closely at that as a primary option. They'll consider alternatives, but they've indicated it's unlikely any alternative would result in more compensation than that. It might even be less in some scenarios. So repayment of the commission is a key benchmark.
Got it. Any other factors in the calculation?
They're also considering what's called a de minimis threshold. Basically, a minimum level of harm or commission value. If the amount involved is really tiny, it might fall below the threshold for receiving a payment. It's partly about administrative efficiency, focusing resources on the more significant cases.
Okay, that makes sense. And interest, if you get compensation for something years ago.
Yes, interest is normally paid on redress. The Supreme Court said it should be at a commercial rate. The FCA's current thinking, which they'll consult on, is to use the average Bank of England base rate for each relevant year, plus an extra 1% per year. Simple interest.
So roughly, maybe around 3% per year, simple interest on top of the main amount.
Roughly, yes, depending on the base rates during the period.
And the timeline. How far back could this scheme potentially reach?
The proposal is quite far-reaching. They're looking at agreements going back to 2007.
Wow, 2007. That's a long time.
It is. It aligns with the period the Financial Ombudsman Service can already look at. The idea is to be comprehensive and also, frankly, to stop potentially thousands of individual court cases popping up, which would be messy and slow for everyone.
Right, avoid chaos.
Yeah.
Which brings up a practical point for consumers. If this goes ahead, will people have to actively apply, opt in, or would they be included automatically, maybe an opt-out system?
That's a really crucial operational question, and honestly, it's still up in the air. The FCA hasn't decided whether to propose opt-in or opt-out.
Pros and cons to both, I imagine.
Definitely. Opt-in means people have to take action, which might miss those who aren't aware or confident. Opt-out could reach more people automatically, but might swamp firms with claims, some perhaps minor. They'll explore this fully in the consultation.
But firms will have to tell people.
That seems very likely. Whichever route they choose, the FCA expects to require firms, where possible, to proactively contact customers who might be eligible and tell them what they need to do. So you might get a letter or email from your old finance provider.
Okay, good to know. You mentioned earlier the Johnson case found a 55% commission was a powerful indication of unfairness when hidden. Is the FCA setting a specific threshold like that?
They're looking at it. The Supreme Court highlighted that high and undisclosed commission was a big red flag, and that disclosing it would likely have changed the customer's decision a material impact. So the FCA will definitely consider what level of commission, in context, becomes problematic if it wasn't disclosed. Defining that benchmark will be part of the consultation.
Now, the numbers involved here seem huge. You mentioned potential industry costs, $9 billion, maybe up to $18 billion.
Those are the broad estimates floating around, yes. They're very uncertain at this stage. Depends heavily on the final scheme design. The FC thinks 9BN is probably the floor, unlikely to be much lower. 18BN might be the high end, but mid-range analyst estimates seem more plausible.
But for individuals, you said potentially less than £950 per agreement.
That's the current estimate for most individuals, yes. It really shows how lots of smaller instances of unfairness across millions of agreements can add up to a massive industry-wide figure.
A systemic issue, really.
Exactly. But despite these big numbers, the FCA does expect the market to remain healthy. People will still need car finance.
Okay, so advice time. What's the key message for firms listening in? What should they be doing now?
The absolute priority is compliance. Follow the law, follow the rules. But specifically on this issue, firms really need to refresh their estimates of potential liabilities. That means not just the compensation payouts, but also the admin costs of handling this.
And put money aside. Make provisions.
Yes, make sufficient provisions in their accounts. Even with the uncertainty, they need to act now and increase provisions if their current estimates look too low based on the FCA's signals. On a positive note, things like the consumer duty and general industry improvements are leading to better outcomes now, but this deals with the past.
And what about handling complaints right now? You mentioned a deadline.
Right. Currently, firms have a pause. They don't need to give a final response to these specific types of motor finance complaints before December 4th, 2025.
Okay.
But, and this is important, the FCA is going to consult on extending that pause. They want to align it with the actual compensation payment schedule under the proposed scheme.
To keep things orderly.
Exactly. Avoid a messy rush of complaints before the scheme is ready. It's about efficiency and consistency for everyone.
Okay, that makes a lot of sense. Now, flipping it around, what's the standout advice for consumers? If I'm listening and thinking, maybe this affects me, what should I do?
The key message is pretty clear. If you've already complained to your provider about suspected hidden commission on a past deal, you don't need to do anything else right now. Your complaint is logged.
Okay.
But if you haven't complained yet, and you're concerned you weren't told about commission and might have paid too much, the advice is complain to your finance provider now. Get it on record.
And do people need lawyers or claims companies for this?
The FCA is very keen that they shouldn't. They aim to design the scheme so it's easy for individuals to navigate directly without needing claims management companies, CMCs, or law firms.
You got to get a cut, right?
Take a significant cut. CMCs can charge up to 30% of your compensation. The FCA wants people to get their full redress where possible. They've already cracked down hard on misleading CMC ads about this forced 225 to be changed or pulled just last year.
Wow.
Yeah, especially ads making wild guesses about payouts. They'll continue to be tough on that. So, rule 1 for consumers. Complain directly to the finance company first.
Okay, so what are the very next steps in this whole process? When will we know more?
Things are moving quite fast now. The FCA is working flat out. They're aiming to publish the detailed consultation paper by early October.
And people can give feedback.
Yes, it'll be open for consultation for 6 weeks. So probably into mid-November. Remember, no final decisions are made yet. This is the chance for everyone, firms, consumers, other stakeholders to have their say.
And the goal is?
The goal is to get the final rules sorted so the scheme can launch properly in 2026. And hopefully, consumers could start receiving compensation payments sometime next year.
Okay, so a big consultation coming this autumn. Scheme launch planned for 2026.
That's the plan.
Well, this has been a really thorough deep dive. We've covered a lot of ground on what the FCA is planning for motor finance compensation. It's clearly much more than just a minor rule change.
Oh, definitely. It's a huge undertaking, trying to bring fairness and order to a massive market segment driven by that Supreme Court clarity and a real focus on protecting consumers.
It really is about addressing those past practices that led to unfairness, ensuring people are compensated, and hopefully setting a clearer path forward for transparency.
That's the aim, greater transparency, greater integrity in the market.
So, thinking bigger picture for a moment. What broader lessons can we take from this whole situation with motor finance commissions? What does it tell us about that constant balancing act between how businesses operate, how regulators oversee them, and how you build real consumer trust in finance?
That's a great question. I think it highlights how seemingly small, widespread issues like lack of disclosure can snowball into enormous liabilities and force a fundamental rethink. It shows the power of legal clarity, like from the Supreme Court, and the importance of regulators stepping in proactively.
And the need for transparency from the get-go.
Absolutely. It's a lesson that really applies across the board in finance, doesn't it? Not just car loans. It touches pretty much every financial product we use. How much trust can you have if you don't have clarity?
A really potent thought to end on. Thank you. Just to remind everyone listening, the detailed information underpinning our discussion today was provided by Compliance Consultant, the home of the compliance doctor.
Highly recommend checking them out if you need expertise in this area.
You can learn more, explore the issues, or get in touch by visiting their website, complianceconsultant.org, or email info@complianceconsultant.org.
The UK phone number again is 0800-689-0190.
And remember that direct link for scheduling a no-obligation discovery call? bit.ly/discover. And don't forget their special 25th anniversary offer, that 25% discount for all of 2025, plus the $9,999 in plus in bonuses. A really comprehensive package from a dedicated team.